Happy Thursday, everyone. Welcome to the Founder Series from Women in Cleantech. We're super excited to have you guys, and thank you so much for joining us. I am your facilitator, Nagashree Manwatkar, and we have in the room Alena, who is from RAR Studio, who's going to be co-presenting this. And Arila, if we can move on to the next. So the first slide, please. Thank you. Yeah, so if you guys are not aware already, Women in Clean Tech and Sustainability has been there for the last 14 years and has been working to improve the parity of women within the clean tech and sustainability field. We also promote network and connections within this community, as well as promote thought leadership within clean tech and sustainability. And as the Entrepreneurship Committee, we also support similar resources and encourage founders and inventors who aspire to drive clean tech solutions in this market. Some of you have attended and participated in our pitch competition. And so we thought about how we can support you all. So we've started this workshop series, which is for 6 weeks. This is our first year. And Rila, if you can move to the next slide, please. Yeah, so FoundHER is a pilot that we're running for 6 weeks, in which we'll provide virtual coaching for you all. We'll give hands-on workshop, and we'll talk about what are the different topics we're going to cover. And we'll have a weekly office hour, which we will be on every Friday. This week one, Alena, who is our co-presenter today, is going to talk about fundraising and cap tables. And then tomorrow, if you guys join us, we will have an office hours where you will get to ask questions. And then the following weeks, you can please feel free to check out, if you haven't already signed up, we have great topics on personal branding and storytelling. We have a legal 101, marketing strategies, building confidence in pitches, and we'll culminate all of this with a happy hour in San Francisco. Next slide, please. So as speakers, we have an exciting lineup of women. Not only are these women who are themselves women entrepreneurs, they've left their corporate job for this great cause, which we are supporting today. And you'll get to meet each one of them to understand how they can support you in individual capacity, in fundraising, through storytelling, through digital marketing, and through coaching. So we're excited to bring these speakers and these workshop series to you guys. Arila, if you can move to the next one. And with that, I will talk a little bit about myself. I'm Nagashree. I'm a board member at Women in Clean Tech, and I chair the Entrepreneurship Committee. I am a founder myself. I'm the founder of Gaia-Force, which is a platform that helps young professionals get upskilled and land climate jobs. I also have 15 plus years in clean tech myself, and I've driven, scaling businesses for solar and storage. And it's been hugely rewarding to be part of Women in Clean Tech. And I would like to welcome Alena to share the stage with me and talk a little bit about her work that she has done and the amazing work she's doing through our studio. Welcome,
Awesome.
Alena.
Thank you so much for having me, and thank you for collaborating on creating this series. I think it's super important, and happy to be here. So yeah, my name is Alena Solonina. I'm a partner and co-founder of Curvepoint Capital. We're late-stage investment firm focusing predominantly on energy transition and decarbonization. So think about more mature companies like Series C and beyond. So I've been doing investing for over 10 years now, across various types of investing across borders and stages. And where I am now for the last 3 years, because it's late stage, I don't see a lot of female CEOs or founders. So most of my weeks comprise of talking to men. And I was asking myself, what's happening? Like, why is that the case? Because when I go to work with accelerators and incubators and various like pre-seed, seed stage type of programs, they proudly say that they have 30 to 40% female founders in a cohort. I'm like, okay, obviously losing them, but why we're losing them? There are a lot of different reasons. We all women, we have multiple hats to wear, from being entrepreneurs and workers, and then we maybe make a decision to start families, and that's big thing for us to handle. Even if we have amazing partners, it's still a lot on our shoulders. So unfortunately, a lot of women just decide to not continue pursuing their goals in a career and switch. The ones that try to balance, they just need support. And another piece that I found is educational piece. It's a lot of you probably as scientists, PhD, spend so much time studying engineering and various type of very hard skills to get to the point when you have an idea and you're ready to launch a company. And now you know all these complicated things that I will never even compete of trying to understand. And then you walk into the room and people throw in this financial jargon at you and think that they're much smarter than you, which is not the case. So I thought, what can I help with? And what I can help with is kind of depuzzle that world for you, how funds work, how investors think, what they're looking for, why they're asking all these questions they're asking, and how to navigate those conversations and provide you with that support and educational resources. And for that reason, I started the RAR Studio. We're in an early stage of kind of forming and trying to figure out how exactly be super helpful. So some of the glimpses you will see throughout this program. And that's basically an educational place where you can come and don't feel that you're asking stupid questions. There is no stupid questions. We can talk about anything. It's a community that I created on Circle just because it's easy, in my opinion, to get that on demand and on your own time. So most of you, probably all of you, if you don't, should have received a link to join, or if you're already a Circle member for other communities, it would add it in your kind of list of communities. So please use that tool to connect with each other, because that's a huge networking opportunity being part of that series. There are 3 various courses there. Something we talk about today, you can take a course on your own time. It's kind of more in depth of what we will cover today. There are other resources there, other conversations, and I really try to put everything there so it's on your fingertips. And you can use that platform to message me directly if you have a question, use the public forum to ask questions, and share your lows and highs. So as much as you want to take out of that, it's there for you. And please let me know, or Nagashree know, if you didn't receive a link or it didn't pop up on your Circle, and we will make sure it works for you. So yeah, today as a week 1, we thought it will be helpful to just give a quick overview of capital markets. What does it imply? What are we talking all about when we talk about equity? We talk about debt, we talk about other stuff. What to think about when we talk about cap tables? It seems complicated, but it's actually not. So we can walk through elements of that, and we will finish it with talking about what the funds are and how they work and what questions to ask and how to navigate that universe. So first thing first, you probably heard a lot of the term capital stack. And what does it mean? Capital stack just means various types of investment into your company that is just stacked, right? And it goes from lowest risk, lowest return to the highest risk, highest return. That's the spectrum we're talking about. So on top of the pyramid, the highest risk, but the highest return is common equity. Common equity is something that gives shareholders voting rights so they can make decisions on the company, depend on how much of course they own of the company. And whatever left after all the other investors on top of you take, that will be distributed to common equity holders. So you as a founder most commonly are owners of common equity. And when you start a company, unless you have a co-founder, 100% of common equity is yours, right? So if you will keep just bootstrapping your company and never take outside money, 100% yours, very simple. You will get highest return once you decide to sell your company, go to IPO or other potential exits. So that's highest risk, highest return. Second is preferred equity. Why is it preferred? First and foremost, it doesn't have voting rights per se, but it takes a priority to get distributions after you exit before common equity. So now you are, no, stay on this slide, please. So now people who hold preferred equity, there will get money before you. So most of the VC people, venture capital investors, angel investors, they would like to take preferred equity. And that's only reason so they're in front of you to getting into distributions. So that's kind of a structure of it. It's kind of a legal distinguisher for them to make sure that they will get their money back plus return before you get any penny. So that's why it will be super important when we talk about cap table to make sure how much you keep it, how much of preferred equity you're staying. So that's the equity component, right? It's ownership of your company, who is making decisions, how is the ownership split. Then a big world is debt. I know a lot of people have a very negative connotation around that. We all use credit cards to manage our cash inflows with our cash outflows and bill paying. It's basically, you should be thinking the same way for your business. You can take a loan from the bank, you can take a loan from private lenders, you can use credit cards the way you're using it for personal use, you can use them for your business. So it's very important to understand cons and pros of that because it can be very powerful tool as you grow. So you can attract capital without giving ownership of your company to preferred equity holders. So someone who is above preferred equity, we call mezzanine debt. I will leave it for that right now because I think it's easier to understand what a senior debt is. Senior debt is lowest risk, lowest return. Why is it lowest risk? Because when you take a senior loan, think a bank. Think you go and you need $100,000 to buy an equipment to manufacture your product. They will give you $100,000, but they say, you need to give me a collateral. You need to give me something that will protect my investment. And usually that piece of something in value, if you will go and sell it today, will be far more beyond that 100K that they're giving you. But that's a senior debt. Their main goal is protect their downside if you lose their money or if the business doesn't go, so they can take that assets and sell it. But that's why they're getting the lowest return because they're not taking that much risk. So senior debt, basically, once you have them, they rule the show. So they will have a covenants in place. They will have different triggers that you need to comply with. And as an early stage founder, it might be very complicated. So I always advise to work with a legal firm to make sure you really understand what it implies when you take a loan, and what do you need to do the reporting, very important, what's collateral is there, what they can and cannot allow you to do with your business, because at this point, they're running the show. And as I said, we're coming back to that middle piece, mezzanine debt. Mezzanine debt is kind of sits in between your equity and your debt, because they kind of saying, okay, If you have a bank on top of everything, that's fine. I will be behind the bank, but before your equity holders, and they can give you capital for that. So they're taking a risk that if the company goes down, that they will not get any money because your senior debt potentially can sell your assets and take all the money because it will be covering that 100K they invested. If there is some residual level, some residual value from them selling your assets, it will go to mezzanine debt. And if there is anything residual from that, then it goes to pref equity and then common equity. So even this pyramid is kind of going from common equity on top to senior debt on the bottom. The way I'm looking at it, it's like senior debt, really secured, very low risk of losing money for those type of investors. And then as we go on top, common equity is the highest risk to lose the money. But if you made it, if you actually get through all the challenges and you sell the company and you go their IPO, the people on top who holds common equity potentially getting the highest returns on their investments. And on their investments, let's put aside the time they invested. It's all about the dollars they invested, right? So because most of the time you hear the horror stories that founders actually didn't get anything from exits, and that's because they were so far removed in that capital stack. But we can talk about it more when we talk about cap tables. So that's what we call capital stack. So various layers of people participating in the journey of your company. We can go next. Next slide. Thank you. I get a lot of questions around the names of the stages and what should I call this round and how should I think about it? Am I pre-seed or I'm seed right now and I'm Series A? So obviously depends on what ChatGPT, how you prompt to ask this question, and depends on the sector you're in and type of business you're running. The answer varies. Honestly, it's something, just a sequence of capital raises, right? So some companies don't even have revenues and they're doing the Series G. It's when we talk about very big, large infrastructure projects that raise billions of dollars before they even have a first dollar of revenues. But I think this table summarizes pretty easily to just like how to think about it. So who is pre-seed? What is a pre-seed company? You have an idea and you don't have revenues yet. Maybe you have some pilots where you have a prototype made from plastic or something like that. And you really just need some money to make that prototype work and show that there is a product to be developed and how it works. And it's really just like think about it as the idea stage. So a lot of accelerators, incubators, very early stage VC and angels investors, those type of people that you will fundraise when you're on idea stage. And that's the best stage to get your family, friends, and fools involved. It's because that's a small checks, right? $10,000, $5,000. It's very kind of not high checks. You just really need to get it going, and maybe like you buying yourself 6 months, 12 months to actually get a prototype done or build an MVP if it's a software solution. So it's a very small checks, very early stage, and kind of, I would say, idea stage. So, but this place, it's a really good to look for grants. So it's non-dilutive type of capital coming from foundations, endowments, nonprofits. Used to be in a climate, obviously government, it's now getting really cut off. But now this kind of philanthropic type of capital is starting to kick in. Family offices, people who really have billions of dollars and they really just want to invest in something that will change the world and they don't care if they will make money or not. So that's kind of on pre-seed stage. Seed stage is when your idea, you have a prototype now. Maybe you have one customer that is actually using it and giving you feedback on how it works, giving you some kind of feedback on what you need to fix, what they would love to see more, but you're still pre-revenue, you're still figuring it out. So you need a little more money to actually formulate your go-to-market and get to that most valued product, something that's like, this is my product, this is what I'm doing with my company, this is like 1-2 customers that use it and said it's great. So this is kind of the seed stage that you're fundraising for. And then Series A, magical Series A is when you know it will work, you have customers that want it, you maybe even have a small revenue generating from some pilots of first commercial customers. You're still burning money, you're still not making anything. So that's where your true venture equity, venture capital coming in. Venture debt in some points, depends on your business model. Still grants are very applicable. And now you can see that you may be able to fundraise from some strategics. Who are strategics? Strategics are huge corporates that basically it's easier for them to give you 50K and use you as a fast R&D lab to show that that solution that you developed will work in their huge scale. And then for you, it's good to get a strategic because you can have some application for your product to show others that it works on a big scale. So that's where the Series A coming in. And then you have revenues, you know your product works, you're on a generation 2, 3, you know you're done with most of R&D, you generating revenue, and you have very, very clear path to actually start making money. Before like Series B, you're losing money every year because you're just investing so much time in product development, in marketing, in attracting customers. So at Series B, it's where like, okay, I've done all of that. I have product that works. I have customers. I need to sell and produce and just scale. So that's where the Series B comes in. And that's, again, a little later stage type of venture capital, some mezzanine financing, as we talked, more private lenders coming in. Banks are getting interested, especially if you have a hardware solution. So there are assets for them to take as a collateral. Grants and strategics are still applied. And growth stage, you know, you kind of made it. You have a company that not losing money anymore. You have a good pool of customers. And now you need to just scale and get to pretty nice profitability numbers and look for an exit, either IPO, merger or acquisition. Someone just bigger buys you because you fit so nicely into what they're trying to do. Maybe strategics are coming in and so it's like, okay, you proved that it works. We're buying the whole thing, and they integrate it in their product. And a lot of people, founders, mistakenly think that after the exit, M&A and IPO, they're done. But most of the time, the acquirer will ask you to stay for at least 2-3 years and kind of finish the transition and make you earn more by staying. So don't think that once you sell the company, you're like done. It's very rare. You probably will stay for another 2-3 years while that product and solution you build being integrated. So that's very high level description of types by stages, but don't get married to it. My kind of view on this is, again, based on the business model, the name of the series can be whatever. It's just for you to understand exactly what venture investors, angel investors want to see at what stage they're investing. So if they're super, super early and call themselves pre-seed, they probably will be okay that this is my idea, this is why I can do it. On a seed stage, I have a prototype and I have a pilot, and that's what we can do that. Series A, I'm generating revenue, I have customers, probably a couple tweaks to my final product, but I'm almost there. And Series B, I'm off the races to grow. We can go to the next slide. So all these people want to give you money. So how to manage not to lose control of your company, and B, not to be that founder that doesn't get anything at the end of this long, long journey because they were holding that common equity. So that's why we track everything in capitalization table. So capitalization table, it's as easy as a table that tracks who's invested in your company and at what stage they invested and how much dollars and what ownership percentage of the company they have. And usually your legal counsel will help you to track all of that. And obviously you have platforms like Carta that makes it very easy to track, but obviously at the beginning you can use simple spreadsheet. But it's very important to keep an eye on this because you don't want to go for Series A and you already own only 10% of your company. Most of investors will be questioning that, saying that you don't have enough incentives to keep going. And maybe your friends and family gave up too much company. And we will talk about it a little bit, but just keep an eye on the capitalization table and think about it as your kind of long road map because you will keep fundraising, you will keep giving up pieces of your company. So you need to make sure that you ended up with significant ownership for you to get paid at the end of the day and actually capitalize on all the time you put into that. B, you know who is actually like can make decisions because once you're losing more than 51, not losing, giving up more than 51% of the company, who is actually making decisions? It's your board, it's your majority shareholders. So you now need to think more broadly about how are you talking to people, how are you communicating with your board, who is on your side, who thinks differently just because they think that you don't know something. So it's very important, and capitalization table helps you to track all of that. You can go to the next slide. So what are the elements of capitalization table? First is shareholders, basically just a list of names, companies, venture firms, other investors that you just track in. You have columns by investment round. So when you did pre-seed, who participated for how much dollar, how much percentage of your company they get. So that's, you track in an equity ownership column. Then other convertible securities potentially will be tracked in a cap table as well. So you hear probably a lot about safes. So your cap table tracks that as well. How many people will convert into the equity holders once you get the next round going, and how much of the company you are giving to your employees. So your option pool, so capitalization table tracks all of that. You can go to the next slide. I really can, thank you. As I said, options and warrants, that table tracks, and dilution. Dilution is such an important concept that it's easy to understand. Like imagine pizza, right? So your company, when you started, you have the whole pizza. And as you raise in money, you giving pizza away. But each piece with each round of the pizza is getting smaller and smaller and smaller, but it's still one pizza. So when you start an LLC or however you want to incorporate your company, you will be authorized for X number of shares. So let's say you started your LLC and you have 1 million shares, right? So if you give someone 500,000 shares, they got 50% of the company. And that's how you should be thinking when you think about ownership and how much people get in, more in number of shares versus percentages, because it's very hard to increase the pool of shares. It's legal complication. You will need to work with the lawyer to allow government authorities to issue more shares to increase that million to a bigger number so you can give out more. And the more you give up, the less the more shares you basically, that million will be growing essentially, then that 500K shares you gave up at first will become a smaller and smaller percentage. So it's a very simple math, but that's what called dilution, right? And that's what people mean when they say like, okay, if I will give you today X amount of dollars, I will get X amount of shares. So after Series B, people come in, for example, what is my fully diluted ownership? So you will need to do a very simple formula to tell him like, okay, if I will bring Series B people and I will increase my share pool, total share pool to X, then your 500K shares will be this type of percentage, which will be less than at the time of their investment. So that's what people want to know. So if I'm coming in Series A and you will still do Series B and Series C, how much will I own of the company after all of that? And that's what they refer when they say fully diluted ownership percentage. And again, cap table, it's where you track all of that and do all this math. And your lawyers should be helping you with that, or your fractional CFO, or if you have a full-time CFO. So this is a very simple example of the cap table. As you can see, shareholders, name of investors on the left, includes outside investors, includes founders, includes your employees incentive pool. You say what type of shares they own, common stock, pref stock, what is the percentage, and then you can see you're just tracking your fundraising story. In this case, there was just Series A, and that's how much of shares you gave up at Series A, what was that percentage out of total shares. So it's all tracks that. Carta made it all very easy, but if you don't want to spend money on Carta, it's absolutely fine. You use your legal counsel to make sure all these numbers are correct, that their job, they're not just good at law, they should be good at math. And that's kind of where you should consult them, and always keep eye on your cap table. We can go. So I think it's when you go out fundraising, it's very helpful to understand how firms like mine, like CurvePoint, works and what do we do, right? So because you have individual investors, it's very easy. They have cash sitting around and they just want to give cash from their pocket. They believe in you, they invest in you. But more professional investment firms, their structure dictates what they can and cannot invest into. And it's super important to understand. And it's super important for you to ask when you're going through the due diligence. So as much as they diligence in you and deciding to give you money or not give you money, it's very important for you to understand, should you be taking their money? And I know it's a very hard concept and idea, because you work so hard and someone is interested, but you really need to think it's a marriage. They will be with you for 10, 15 years. And if they're not bringing anything but cash, does it worth it right now? Does it worth it to give up that 10, 5, 20% of the company just for cash? Or how to identify that VCs are actually just, sorry for my French, effing around and wasting your time, because maybe they just don't have even money to give you, and they're just justifying their existence by creating busy work and learning the market and gathering market intel for their portfolio companies. So that's very important, because especially female founders, they burn on this a lot, because we're not asking all these questions. So let's understand how the venture fund, later stage growth fund, any fund, professional investment firm works. So we're essentially a company as well, but the way we make money is finding companies like yourself and investing in you. So we're intermediary between people who hold funds and companies. And we are just professional investors in terms that we can diligence you, we can form a view on the market and a vertical, and advise people with money to do it or not to do it. And we get paid for that. So that's my business model, right? I get paid to go out and find a good company and make a good investment and make money for other people. That's what institutional investors are. So our capital providers, we call them limited partners. So they are partnering with the teams like mine because they have such a big pool of capital, and for them, they need to create huge teams to deploy a billion, 3 billion, trillions of dollars. So instead of going and investing in individual companies, they invest in like general partners like myself. So they will give me 100 million, and then I turn around and invest it in 10 companies. So it's already streamlined their process, and they will pay for me. So limited partners are usually pension funds. So you all heard of like public pension funds, probably running your pension. They have enormous amount of capital to invest because they need to keep making money to give you your pensions when you retire. Insurance companies, all the premiums they collect from us, they need to invest because once there is time for them to pay, they need to have money. And obviously family offices, some of them are small, 10 million in capital, some of them billions, some of them it's a multi-family office, so several families just combined on one platform. And again, individuals, foundations, endowments, and sovereign funds. So all these people with capital come, give me money, and then I go and find you guys to make sure that the LPs make money. So, but I cannot just do it, right? Why they pick me? They pick me because I know what I'm doing and they want to have equity investment, or they want to diversify their risk and start to do equity and debt, or they want to do both. So they're really looking for experts in one specific, what we call asset class. They want experts in who is doing early stage investments. It's very different expertise in doing growth stage investments. It's very different expertise of what doing debt investments. So they will pick various investment firms to allocate their money to, depends on what they're looking for. The stage will be different, what type of companies I can invest to. So my like what we call mandate, I'm allowed to invest only companies with positive EBITDA. So even if I love you and I believe in you 100%, besides giving you my personal money, I can't invest from my funds because it's not what my LPs hired me to do. Check size, same, structures, sector specific. I'm very climate focused, so people hire me to invest in climate companies. Of course, I can probably talk them into doing something else on deal by deal basis, but they know that I'm a climate person, so do climate. Don't go and turn around and suddenly start to invest in oil and gas. Like that would be outside the mandate. That's not what we hired you to do. And there are a lot of other factors, but those four, it's very important to understand. So go next, please. Thank you. So now you know I have check boxes to check as an institutional investor that potentially writes you a check. So how for you to know what boxes should I be checking? Do I have money to give you? So that's kind of my cheat sheet of type of companies, a type of questions, sorry, to ask when you're talking to VCs or talking to other investors. Like ask these questions, like what is total size of your firm? What the size of the fund you're currently investing from? Is it a $50 million fund? Is it a $100 million fund? Is it a $5 million fund? So depending on the size, what is this check size you're writing? Are you doing $5,000 checks or you're doing $10 million checks? And fund life, people like LPs give me money not for infinite amount of time. I need to give that money back plus return within X amount of years. And usually for earlier stage investment, it's probably 10 to 12. So for them to invest in you today, they need to make sure that they can get money back within that period so they can turn around and give money back to their LPs. And that's why you asking them what fund life you have remaining, meaning how long will you stay with me until you will say, I need my money back. We need an exit. And I will start pushing you to exit because I need to give money back to my investors. So that's a very important question to ask. How much dry powder? What is dry powder? How much cash do you have on a balance sheet that you still have to deploy? They still have to invest. So that's important. This will like hesitation to answer that question may tell you that they don't have money and they're wasting your time. And the question, are you currently investing? Like what is the last 3 deals you've done? When? This is type of questions you should ask, and that will create green or red flags for you to understand should you be spending your time with these people. Are you planning to fundraise in the near future? Meaning, are you running out of money? Are you successful in what you're doing? Because you will be going to fundraise for the fund 3, 4, 5, and that will give you another view into if they have capital to support you. What is your return profile? It's a very specific question. Again, just coming back to the cap stack, the earlier they're investing, the bigger risk they're taking. So that question will help you to understand, do you fit that? Will you be 3-time valuation in 10 years? Can you grow that much, that fast, or 10 times valuation in 10 years? So it's like you need to kind of align of how fast can you grow your business and how fast they want you to grow your business. Obviously, for venture capital, they want huge numbers, not always realistic, but you need to understand like when they will start to push you for an exit. Typical structure, again, are they equity? Are they convertible notes? Do they do debt? Like what type of investments are we talking about? Because not every venture capital is the same. Are you taking minority or majority stake? Do you want to own the company and tell me what to do? Or you are okay to be on the sideline and maybe just advise me? Do you lead the round or you follow? And that's a very important too, because unless you have a lead, even if you have a lot of other people interested, but they don't want to lead, you will not close the round. So you need to focus on people who are confident enough to set a valuation for you and write a significant check in your round. So that's what we call lead investor. And are they reputable enough that others will like, you know what? Like, yeah, if those guys are in, we're in. And I will always advise to first identify who is your lead and then spend time with everyone else because the lead is the hardest one. Ask them how they will be helping you day to day, especially if they're taking a board seat. Like, don't give up board seats left or right. It's a very important job to grow your business, and ask for reference calls. Ask to talk to other founders and portfolio companies that they invested in, and ask them what value did they bring besides cash. So that's a very important piece as well to make a decision if you're into this marriage or not. And then walk me through your investment process. Like, how do you make decisions? How long it will take? How many investment committees do I need to pass? How many in-person meetings do I need to take with you, or site visits? Like, all these questions are very important for you to just categorize investors and make sure you're spending time with the right ones. Yeah, and go through their websites, make sure they actually understand the space you're in, understand the problem you're trying to solve, that they made investments in the similar sectors and the similar solutions. Chat with them with their views on the long-term prospects of that sector, and do you agree with them? Do you want to challenge them? And the last one, kind of, we already covered a lot. It's like, what's your value add to the company? Like, why should I give you 15, 20% of my company? What are you bringing to the table? So those are all super important questions. Probably not for the first pitch, but when you get that first in-person meeting, I would like, save some time to ask all these questions. And by asking all these questions, they will understand that you are not the one to F around with and really be serious, and that you know what you're doing and know what you're talking about. And it will just bring more confidence that you have a very, very straight vision about how to grow your company and who should be investors in your company and who should not. Next one. Yeah, that's kind of a very high level on fundraising and cap tables. Again, there is a full course on Circle that you can dive in and ask questions there. Maybe just DM me if it's a very specific question to your company. But this is type of information we kind of tend to bring, and I hope it was helpful for our week one. Yeah, Nagashree, you want me to take a couple questions, or what should we do next?
Yeah, so let's do this. Thank you, Alena. Oh my God, I feel like a part of my brain just opened up. I'm a founder myself, so all the things you shared about the cap, stack, what questions to ask. I just feel like I'm so much more equipped with things to address my startup, and I'm in pre-seed myself, so I've got lots to do. So yeah, we have about, I would say, 13 minutes. I'm going to talk a little bit about WCS, how to get involved, and it'll be a quick run through some, slides. But at the end of it, I think we'll be left with a few minutes. What I would love, Alena, for you to do is to share the circle and how to navigate it, and then we can open up for a couple questions. But more importantly, for this audience today, the structure of this workshop series that we have is tomorrow, Friday, from 11 to 12 p.m. PST. Please come and join us to ask your questions. There'll be Alena and Lisa tomorrow, who is the co-founder of our studio with Alena, and you can ask them your personal questions. And so you have both forums today. If there's a pressing question about the slides that Alena presented, you can ask that, and I'm going to go over some high-level details of WCS. So here is a QR code. I know you guys are just starting up as founders, but for people to get involved with Copper membership, there are ways to do that. If you want to do that, please reach out to us. Arila, on the next slide. Yeah, and virtual membership. I know some of you are part of the San Francisco region, the LA region, and so forth. So we have chapters in San Francisco, in Los Angeles, in New York, and there you can come and meet us in person, but there's also virtual membership. And if you guys aren't members yet, please join us. We need to collectively create this momentum. And if you join us, we can support more women entrepreneurs as well as the cause of WCS further. Next slide. There's amazing merch here. My favorites are there's the future is female and cups and all of this to support women in clean tech. So please check out our store. Next slide, Arila. Here's where you can find us. You can find us on LinkedIn, Facebook, and Instagram, and all of these great places. Please come and support us. Follow all our different, endeavors that we're pursuing. I will personally be posting about this series, and I would love your support in sharing the impact of this this workshop with your community. Next slide. Yeah, and today's volunteers, thank you so much, Arila. We have Ashi, Evin joined, and many of the volunteers. We won't be able to do what we do without our wonderful volunteers. So I'm super thankful. And then our marketing coordinator, Mary Kay, who puts together amazing, visuals for both LinkedIn and Instagram. So I thank her. And Alena, thank you again for supporting such a great cause. Please come and join us and support the Entrepreneurship Committee. So I thank you all for joining. With that, we come to an end of this. And Arila, if you want to stop sharing your screen, and we can have Alena share her screen to show how to get into the RAR Studio Circle.
Yeah. Yeah, as I said, you guys should either email if you never use Circle, or it will just pop up right here. Is it not yet sharing? Is it sharing?
You can see, we
Okay.
can see your screen,
Yeah.
Alena.
So yeah, you either will be asked to create an account in Circle and join the community through the link that I sent to everyone applied yesterday. If you applied later or didn't receive it, please let us know. If you already have an account on Circle, it should pop up here on the left. And you all get full access to the platform for free. No time limits, nothing. So yeah, this is a landing page, very straightforward. On the left, you can see various spaces. You can learn about RAR and what we are trying to accomplish here. You can ask a question and ask or share. Maybe you saw an interesting article, or you want to ask a pretty significant question and gather people's feedback. So you can do that. Upcoming events usually just pops in if we are doing something with RAR. You will not see this series on this specific tab just because the team sent links to everyone's personal calendar, so it would be just a little messy to navigate who signed up for who. So, but everything that RAR will be doing is in the upcoming events. The vault is just a place for me to drop some resources that I think is very valuable, and I wanted to share maybe some templates or some databases or some kind of descriptions of various alternative fundings besides venture, which there are a lot. And I know it's a little overwhelming, but that's why I'm trying to create this kind of resource library. Here it's a place for you guys to communicate. In announcements, you will see what's popping up, what are we doing, what we're trying to, maybe a new course, or we got a new talk, or we're doing some new online webinars. You will see it's an announcement. Please come say hello, just share your story, what we can help with. Maybe you can network with each other and learn more about each other. I know you guys been pretty active in this chat, so it will be helpful just like memorize everything on Circle as well. And so people know who is who in the room, and maybe you're building something very similar and you want to share notes. Founder chats, it's your place to talk and like, oh my God, like what is this people in the government are doing today, and vent and just place where it's free. Like you can ask very fun question or share a thought, or if you have a very specific something you think people may know, just feel free. Video library is just the library of last webinars we've done before this series, so there is some goodies there. And the courses, it's kind of, this course is what we start covering today. It's breakdown by lesson, so you can listen it at your own time, and there is comment section, so you can ask questions specifically for that course of that specific lesson. So there is a capital markets overview and how to determine your best investor. So what we just chatted about, very, very more in detail. Financial statements and modeling. Again, it's going through all three statements, how to think about it, how to use it in your decision making, how maybe some fundamentals of financial models as well, and building a strong foundation for your startup. A lot of legal information. So we've done this kind of legal one-on-one series before with one of the councils I work a lot with. So there's a lot of about incorporation, cap tables, some information on managing the board and other goodies that you need to think about. So that's all in the course, and that's kind of it. But really encourage you guys to use it. I know it's like another platform, another thing. I get it, but really, the more you want to put into that, the more you will get out of that, because I'm personally really determined to help you. And if you will give me an idea, it will be great to have a chat about this or that. It will help me to create more relative content for you. So yeah, thank you.
Awesome. Thank you so much, Alena, for sharing how to navigate this. We have 4 minutes left. If somebody has a pressing question about what Alena presented today, I want to remind that we have a session tomorrow for you to bring a question. And we also have a series. So the next series is September 25th. We are going to talk about storytelling and branding by Kieran. So please, if you haven't signed up, sign up for that. But if you have a question, you can unmute yourself and ask.
You know, it's intimidating to ask in front of 30
Yes,
people.
I think on tomorrow is exactly that session where we are probably going to break up into little breakout rooms and talk to each other in more intimate setting. Arila, I saw you unmuted yourself. Did you have a question?
Yes, I do. I'm curious about how partnerships with tax-exempt nonprofits play into the decision of investing or managing
That's a good
liability.
question. I hate to say it depends, right? Because I saw some people are from LA here. So we have LA Cleantech Incubator, right? It's nonprofit, but it has so many programs to help facilitate pilot projects and find customers and facilitate investor talk. So when I, for example, see someone who went through LACY program, like it gives me like, okay, it's some kind of a stamp of approval, and there is something for me to look at. So it really depends. Like if it aligns with what you're trying to build, and that partnership with that nonprofit helps you to build the case that your product solves a solution, or solution or product solves a problem, sorry, then yeah, it's nothing negative, unless you're building a rocket, but you're partnering with, I don't know, a beauty nonprofit that makes it's very like something very similar. It just doesn't give anything to prove that there is a place for your company in this world.
Thank you.
Awesome.
Alexa, did you raise a hand?
I did, thanks. Hi, thanks so much for the presentation. Really helpful for my stage right now as I'm raising a seed round. I'm actually in this weird situation where last year was pretty tough for clean tech companies trying to raise, and I ended up taking out a loan for 130,000. So it wasn't huge. I mean, we've already raised $500,000 and over $1 million in grants, but it was just enough to like stretch our runway. And now I'm running into a situation where my investors are just freaking out that I have debt on my books that has the, I guess, UCC collateral aspect that I had no idea when I took it out. I should have consulted people, but of course, like we had no money. So did I want to pay my lawyer to look into it?
You do want to pay your lawyers,
I know,
guys.
I know.
You do.
No, but I did consult some people, but just is kind of like, I'm not convinced that I made the bad choice in getting the loan, but I'm curious if you have any advice on, well, one other tidbit of information is I am actually trying to work with Lacey Debt Fund to refinance that loan. And the investors don't know what they are. And this particular investor is actually, well, I'm going to leave that out for now, but they're legit. They're a good investor here in New York. And I guess, do you have any recommendation on how to sort of navigate that around trying to get investments after you've taken on senior debt?
Absolutely. Like full disclosure, like Curve Point is a private credit shop. So I am a lender in my day-to-day investing. So I think it's a really good tool. What the challenge is when you don't know what you don't know. So you didn't know they filed UCC claim. UCC claim is basically says that they have lien on everything this company owned. I hope you didn't give personal guarantee. Please tell me you didn't.
No, that was the one thing that I knew to check that they didn't take.
Good.
Yeah.
Guys, never give personal guarantees.
Yeah.
So yeah, read the loan docs. Like open it up and go line by line. When do you need to pay it? When is the maturity? When do you need to pay interest rates? When you need to start amortizing? What type of reporting you're supposed to be doing? How frequently? And all these pieces, if you're not compliant, that gives them a chance to take over, right? This is like covenant breach or non-payment gets you in default. And those things trigger them taking over and having power. So unless if you're compliant with all of that, there should not be any worry from other investors that they will, because they will not have a legal substance to go after you, because you're paid on time, you're doing all the amortizations on time, you're doing all the reporting on time. So legally, there is no right for them to go after you. And secondly, everyone needs to understand it's a lot of legal money to actually foreclose on a company. Like most of the time, like I invested over $1 billion in my career, and the last thing I want to do is go foreclosure and take over the company. I don't have time. It costs enormous amount of money. It's very lengthy. So even if you're running against the clock to pay interest and you just don't call them and say like, hey guys, this is what's happening. How can we negotiate something? Installment, like they don't want you to fail. They want you to pay. Like, if it's in like additional fee because you're late, or they will just forgive you because it's a couple days, but constant communication with your lenders, it's get you far, trust me. So yeah, read the docs, highlight everything that you feel that you need to comply with, call your loan officer or whoever invested, have a chat, and like and tell them that you're talking to Lacey and you have a pass through how you potentially will be taking them out. It always gives a lot of confidence. And yeah, Lacey Debt Fund is a very, very good place. Yeah.
Okay.
Awesome. What a great question, Alexa. I'm glad you brought this question to the forefront. Tomorrow is just that time to bring your individual questions, get to know each other also. So we've a little bit over time, 3 minutes. Thank you all for joining us. I'm super excited about having this series, and this is just a pilot. We will do more, and we want to hear from you. What else do you want from us? So thank you so much for joining. Have a wonderful rest of your day.
Thank you, guys. Chat tomorrow.